Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be diving deeper into a very popular dividend stock in the UK. This stock is used by millions on a daily basis, mainly for all of their essential breakfast and lunch needs. It's actually a stock that resembles well with me due to the fact that I'm from Newcastle, and that's where this company originated. Having said that, I would never buy a stock due to sentimental value or anything of that sort, so I can assure you that has nothing to do with today's video, and I'll be highlighting the reasons why this is such an attractive stock to buy right now. That stock is none other than Greggs, stock ticker GRG. Big shout out to Newcastle United Football Club as well, winning our first piece of silverware in 70 years. The first one in my entire lifetime. Was an unbelievable final last month to watch, and was so buzzing to see them actually perform so well against Liverpool and batter them. Could have been easily 4 or 5-1, but to come out with a victory and get the trophy was huge for the boys, so big up Eddie Howe. But let's get back to the video and have a look at Greggs. Greggs is a prominent UK-based food on-the-go retailer renowned for its bakery products such as sausage rolls, sandwiches and pastries. The company operates a vast network of outlets across the United Kingdom. The company operates a vertically integrated business model controlling much of its supply chain from production to retail. Greggs is known for its affordable pricing, making it popular among UK consumers. The brand has built strong customer loyalty, especially among commuters and workers looking for quick, affordable food. The company has expanded beyond traditional bakery items to include a range of hot drinks and foods and healthier options. If we dive deeper into Greggs and have a little bit closer look at some of their stats, we can see they are based in the UK, part of the consumer industry, have a market cap at 1.91 billion. They went public back in 1984, have over 33,000 employees with a 5-year dividend growth rate at 7.87% and a dividend yield currently sitting at 3.67%. On the graph, it shows you their 6th month performance being down over 40%. And that's why in today's video we are going to have a look at, is Greggs stock a good buy right now? So we're going to start off by looking at some major business segments impacting the stock performance, with the first one being company managed retail activities. This segment encompasses the operation of Greggs' own retail shops, which form the core of the company's revenue stream. As of January 2023, Greggs operates over 2,450 retail stores, including 500 franchised outlets, and their business-to-business channels. This segment involves sales to franchise and wholesale partners for resale in their own outlets. The performance of both of these segments significantly influences Greggs' stock price. For instance, recent reports indicate a slowdown in sales growth within company-managed shops, with like-for-like sales increasing by only 1.7% in the first 9 weeks of 2025. This was down from 2.5% in the previous quarter. This deceleration has been attributed to adverse weather conditions and really hit consumer confidence, leading to a notable decline in the company's share price. That is why this price saw a huge dip over 10% in one day the other week. And in summary, the financial health and growth prospects of Greggs' company managed retail activities and B2B channels are pivotal in determining its stock price movements. If we have a look at some investment considerations to do with Greggs, their financial performance and growth trends, Greggs has demonstrated robust financial results with total sales surpassing 2 billion for the first time in 2024, reflecting an 11.3% year-over-year increase. However, a deceleration in like-for-like sales growth has been observed, decreasing from 8.2% in early 2024 to 1.7% in the first 9 weeks of 2025, as we've already highlighted in the last slide. It is still growing, and there are some other positives to do with this company that I will show you in this video, so I don't think that it's slowing down to 1.7% is of major concern just yet. The next investment consideration for Greggs is their strategic expansion initiatives. Greggs continues to pursue an ambitious expansion strategy aiming to increase its store count to over 3,000 outlets. In 2024, the company opens a record 226 new shops, reflecting its commitment to growth despite economic pressures. This expansion includes exploring new formats such as drive-thrus and smaller grab-to-go outlets to diversify its reach, thus improving their consumer base. I only see them continuing in this way, especially with the 3,000 outlet goal. Another key one for the company moving forward is their digital transformation and customer engagement. Investments in digital channels have been pivotal for Greggs. The Greggs app was utilised in 18.3% of company-managed shop transactions in the first half of 2024. This was up from 10.6% in the same period in the previous year, indicating enhanced customer engagement. Additionally, partnerships with delivery services like Uber Eats and Just Eat have expanded Greggs' market reach. I really like their moving with the times approach, and it gives me confidence in the company long term. We then have economic environment and consumer behaviour. The UK is currently experiencing economic challenges including weak consumer confidence and stagnant GDP growth, which have impacted consumer spending habits. Research indicates a 14% drop in snack consumption from 2020 to 2024, influenced by health trends and economic concerns. These factors may affect Greggs' sales performance, particularly in discretionary spending categories, but having healthier new options on the menu is definitely helping to combat this. Not only this, Greggs' very competitive pricing, especially compared to other fast food chains, means they are still a strong go-to for a quick breakfast or lunch in a lot of people's eyes. The next investment consideration is their competitive landscape. As we know, Greggs operates in a highly competitive market, facing challenges from not only quick service restaurant chains, but also supermarkets offering meal deals. Its value-focused proposition and ability to adapt to changing consumer preferences are crucial for maintaining market share, and one I'm confident they will continue to keep on top of. As of October 2024, Greggs shares have provided substantial returns with a total increase of 480% over the past decade. Compare this to only 90% for the FTSE All-Share Index, and it shows how strong Greggs has really been performing. The company's strong brand and strategic positioning continue to support its long-term growth potential, coupled with the brilliant dividend yield. It's a stock that at these current prices seems too good to pass up on. Next up, we're going to have a look at Greggs' fundamental analysis, and they have some very strong numbers across the board, so let's dive straight into it. First one being they have positive net income at 137.3 million, positive gross profit at 1.2 billion, positive operating income at 186.4 million, exceptional 3-year revenue growth at 22%, fantastic ROE currently at 29%, solid long-term solvency, a high Altman Z score at 5.28, high interest coverage at 15.28, low debt to equity at only 0.55, and their only negative being they have positive net debt at 131.6 million, but this is comfortably covered by their free cash flow being at over 149 million. And speaking of free cash flow, let's have a closer look at Greggs' free cash flow and how it has changed over the last 10 years. As you can see from the chart, Greggs maintained a steady increase in free cash flow between 2014 to 2018, driven by consistent growth in operating cash flow and controlled capital expenditures. In 2019, there was a significant surge in FCF, and this was attributed to a substantial rise in operating cash flow, reflecting strong operational performance. Then in 2020, the COVID-19 pandemic led to a sharp decline in FCF, resulting in negative free cash flow of 15 million. Their operating cash flow dropped due to store closures and reduced consumer activity, but have since had a robust recovery, with FCF reaching 251 million, supported by a rebound in operating cash flow and prudent capital spending. During 2022-2023, although their operating cash flow continued to grow, increased capital expenditures, particularly in 2023, led to a moderation in FCF growth. But this isn't necessarily a bad thing, as if you take a closer look, we can see that Greggs' strategic investments in store expansions and digital initiatives are why it has leveled off, and over the long term, they will be reaping the rewards. Overall, Greg's free cash flow trajectory over the past decade showcases its resilience and strategic adaptability in navigating economic challenges and capitalizing on growth opportunities while also maintaining a very healthy payout ratio, currently sitting at under 50%. Next up, we're going to have a look at Greg's intrinsic value. Intrinsic value represents the perceived true worth of a company's stock derived from fundamental analysis rather than its current stock price. For my intrinsic value, I use the DCF and relative valuation methods to come up with the best, average, and worst case scenario. Right now, Greg's price is 1,870 GPX, and on my worst case scenario, they were valued at 2,216 GPX, on the average case being worth 3,133 GPX, and on the best case being worth 4,731 GPX. I not only look at the intrinsic value, but I also look at Wall Street estimates when valuing a stock to come up with my final overall stock prices. The Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that leads to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There are multiple analysts for a large to mid-cap company, so a stock the size of Greg's would have multiple analysts looking at the stock on a daily basis. On the worst case scenario, they believe over the next 12 months that Greg's would be worth 1,750 GPX, which is a 7% downside on that current price. On the average case, they believe they'd be worth 2,927 GPX, which is a 56% upside on that current price. And on the best case scenario, they believe Greg's would be worth 4,242 GPX, which is a massive 126% upside on that current price. What does this mean? Well, now I can come up with my best, average, and worst case scenarios for Greg's and see if they are trading at an attractive price. On the worst case, Greg's being worth £19.83. So with a 10% margin of safety, you'd be looking to buy them at £16.72. And with a 20% margin of safety, you'd be looking to buy them at £14.74. On my average case being worth £30.30. So with a 10% margin of safety, you'd be looking to buy Greg's at £27.27. And with a 20% margin of safety, you'd be looking to buy Greg's at £24.24. And on the best case price being valued at £44.86, with a 10% margin of safety, you'd be looking to buy them at £40.37. Or with a 20% margin of safety, you'd be looking to buy Greg's at £35.88. What does this mean for Greg's? Is the stock a buy right now? Well, I think investors should weigh Greg's strong financial performance, strategic growth initiatives, and digital advancements against the backdrop of economic headwinds and competitive pressures. The company's ability to adapt to changing market conditions and consumer behaviours will be pivotal in sustaining its growth trajectory, but with this being one of the biggest businesses in the UK, I only see it growing further. I, for one, think that right now these prices are too good to pass up on. From my valuations, you can see on the average case price that the company is extremely undervalued, and coupled with the fact that you are already receiving a dividend yield at over 3.7% and they have a healthy 5-year growth rate at over 7%, I know what I will be doing. Thanks for watching today's stock analysis video. If you're building a portfolio for passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. Do you own this UK dividend paying stock in your portfolio, or do you want to see more videos like this one? If so, please let me know in the comment section down below. And until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.